Hey everyone, welcome to our final video on risk and return. And yet we're going to be talking all about beta. So we'll discuss what it is, how it measures risk, and how it's relevant to the well-diversified portfolio. So beta, another measurement of risk, specifically systematic risk, and it's relative to an individual security or a stock versus the overall market as a whole. Okay, so when we're dealing with the market as a whole, we really want to think of it as the baseline index. So when we see a beta of 0, that means that it's on average with the market. So that means that it's very similar in risk to the market. But when we see a beta below 1, then we recognize that that means it's a less riskier investment than the market. Utility stocks is a good example. Typically energy companies, companies that provide electricity, something very important and very much a necessity for the public. Those are common stable stocks, lower betas. Betas that are above 1 are considered more risky. So high-tech stocks, companies, even companies that are stable like Apple, are still considered more riskier investments, and you'll typically see them having a beta greater than 1. Now, there are securities or investments that are at a beta of 0, and what that just represents is that they are independent in terms of risk from the market. A good example of that is a treasury bill. If you remember, they're only concerned with the risk-free rate. They don't really have any other premiums or risk associated with them. So, we're not going to get too much into the statistics of it, but really the idea is that we're comparing the returns of the individual stock versus the market returns. And again, the idea is we're trying to measure specifically the systematic risk of that stock. Okay. Now, the nice thing about this is that if we actually have the individual stock betas, what we can do is we can actually use the weighted average to figure out the actual portfolio beta of an entire investment portfolio. Okay, and we do that using this little equation here. And again, very similar to the weighted averages that we've done previously. Now we're just trying to figure out the overall portfolio beta of our investment. So how do we calculate a portfolio beta? Well, let's get to it. So John is our investor, and he's actually going to invest in 4 different stocks. So we have X, Y, Z, and K. And as you can see, that he's invested different amounts in each stock. So that's something we have to consider as well. And we've also been given the stock's beta for each of these stocks. Okay, so you can see now we can start to even get an idea of which stocks are riskier versus ones that are less risky. Okay. And what we need to do is figure out what is the portfolio beta. Okay, so again, we have individual stock beta, but we want to know what's John's overall risk level in terms of the overall portfolio. So let's go ahead and we'll use this as our reference here. Now, how do we get the weight? Well, remember again, we want to figure out what proportion of investment is made in each stock. So in other words, how much weight or how much stock of stock X compared to his overall investments. So if we add up all the investments, we know that the total amount of investment is $150,000, and then we want to figure out what proportion of X or stock X did John invest in. So we take the $25,000, divide by $150,000, and that's how we get our weights. Okay, and we can see that all the way through. So again, if you look at stock K, it looks like a third of his investments are in stock K. This is why he has the highest weight associated. So once we have our weights and we've been given our beta, we can really go ahead and basically just trying to figure out what is the weighted average of our betas. So again, we'll use our equation here, but ultimately we're just going to be taking the weight times the beta plus for stock X, which is what we see here, and then we're going to add the next stock, which is a weight of 20% invested in stock Y, which has a beta of 1.3, and so forth. So that's all ultimately what we've done here. Sorry I didn't color code it for you, but I think you should get the picture, all right? And once we do the math, we can actually calculate a beta. So we now have a beta of 0.55. And you should hopefully recognize whether or not this is considered an overall risky investment or not. Again, just compare that to the market index at 1. So in this case, the beta is below 1. So it looks like he has a very low risk investment portfolio. So just a bit of a recap in terms of measuring risk. We've talked about 2 ways to measure risk. Okay. Remember, we discussed standard deviation or the variance, and now we're discussing beta. Now, what is the difference between these two? Well, standard deviation measured the total risk of an asset. Okay, so we included both systematic and unsystematic risk. And as you know now, beta only measures an asset's systematic risk. Okay, and remember, what is systematic risk? Well, it's non-diversible risk. Okay, so there's nothing you can do about it. It's not avoidable. Really, again, it's that big picture, really economy, kind of inflation, recession kind of risk that we can't really control. But if you recall, with a well-diversified portfolio, we've pretty much eliminated or reduced unsystematic risk, if you recall. So with that being said, usually if we have a well-diversified portfolio, then we don't really need to worry too much about unsystematic risk. And we're only interested in measuring systematic risk. So this is why we can actually use beta to measure risk. But if we don't have a well-diversified portfolio, then this is when we would go back to our standard deviation to measure the risk of an asset. All right, there you have it. 2 different ways of risk measurements. Again, really our focus is on beta, so hopefully you should now have an understanding of what it means to have a beta above 1 or below 1, and recognize why we would only apply it when we're measuring a well-diversified portfolio. Thanks for watching, and happy financing.